Welcome to Portfolio Casts, the podcast where we break down real investor portfolios.
In this episode, we're exploring Nelson Peltz from Trian Fund Management's portfolio, the key holdings, the concentration, and the thinking behind it.
Nelson Peltz is not a name you want to see on your caller ID if you're an underperforming CDO. He is the ultimate activist investor. Right now, Trian Fund Management is overseeing a portfolio worth $4.5 billion. He doesn't just buy stocks. He buys a seat at the table to force change. Mike, looking at his current top 3 holdings, it is clear he is still playing that high-conviction game.
You are absolutely right, Sarah. Peltz doesn't diversify for the sake of it. He concentrates his bets. His top 3 positions alone make up nearly 80% of the entire $4.5 billion portfolio. The largest position by far is Janus Henderson Group, or JHG. He is holding over 31 million shares. That is worth roughly $1.53 billion.
That is a massive stake. It represents 34.5% of his total portfolio. Why is he so heavily weighted in a global asset manager right now?
It is a classic Peltz play. Janus Henderson has been through some structural shifts. Peltz has been pushing for better scale and cost management there for a while. If you look at the fundamentals, the price-to-earnings ratio is sitting at 13.4. That is quite reasonable for a firm with $3.48 in earnings per share. It's not an expensive stock.
And the dividend is notable too, right? I see the yield of 3.35%.
Exactly. He is getting paid to wait for the turnaround to fully manifest. The stock is trading at $47.95 today. That is very close to its 52-week high of $49.42. It has had a strong run from its low of $28. Peltz hasn't made any recent changes to this position. He seems content to let this 7.7% overall gain keep riding.
It's interesting that he hasn't trimmed it even as it nears that 52-week high. He must see significantly more upside or more internal changes he wants to see through. But let's move to the second heavy hitter in the portfolio. General Electric is still a massive part of his strategy.
General Electric is his second largest holding at 29.5% of the portfolio. He owns about 4 million shares. That position is valued at over $1.3 billion. Now, GE has been a wild ride. The stock is currently trading at $324.17.
That is a huge number, especially when you look at the 52-week range. It started at $159.36. It has more than doubled in a year. Mike, the price-to-earnings ratio here looks a bit scary at 41.1. Is Peltz worried about the valuation?
He hasn't blinked yet. He didn't change his position size recently. You have to remember, Peltz was a huge advocate for the GE split. This is the GE aerospace era now. While a 41 PE looks rich, the market is pricing in a dominant position in the aviation sector. His overall gain on this is 7.8%. But that doesn't tell the whole story of how long he's been involved in the GE transformation.
The dividend is much lower here though. Only 0.45%. This isn't an income play like Janus Henderson. This is a pure industrial turnaround story.
Definitely. He's looking at the $7.51 in earnings per share. He believes the operational efficiency he pushed for is finally hitting the bottom line. Recent news even links GE's trajectory to other aerospace giants like Rolls-Royce. It's a momentum play now, which is a bit different from his usual deep value hunting.
Speaking of value hunting, let's talk about the third spot. Momentum Corp. This is a newer name for many investors. Peltz has 15% of his portfolio here. That is $725 million.
Solventum is the healthcare spin-off from 3M. This is exactly the kind of corporate carving Peltz loves. The stock is at $85.69. What stands out to me is the valuation. The price-to-earnings ratio is only 9.8.
Under 10? That sounds like a bargain compared to GE.
It really is. Especially when you see the earnings per share are $8.69. Peltz is already up 17.4% on this position. It's actually his best performing top holding in terms of percentage gains. The stock has climbed from a 52-week low of $60.70.
It dipped slightly today, down about 0.5%. Does that change the thesis?
Not for an activist like Peltz. He thrives on these spin-offs because they often start undervalued. They are ignored by the market because they are messy. Recent news shows competitors like Thermo Fisher are finding momentum. Peltz likely sees Solventum as a lean, focused healthcare play that just needs the right operational oversight to unlock more value.
It is fascinating to see the contrast. You have Janus Henderson at a 34% allocation. Then GE Heat at nearly 30%. Then Solventum at 15%. That is nearly 80% of $4.5 billion in just 3 companies. He is not just an investor, he is essentially a shadow partner in these businesses.
He really is. When he owns 31 million shares of a company like Janus Henderson, management has to listen. He's looking for that 9.6% overall portfolio gain to climb much higher as these companies lean out. He's maintained his positions across the board lately. No trimming, no adding. He is in the execution phase of these investments.
The total portfolio value of $4.5 billion is up 0.66% today alone. That's a gain of nearly $30 million in a single day. When you have these massive billion-dollar positions, every cent matters. Mike, when we look at the P/E ratios across these 3, we see 13, 41, and 9. It's a very eclectic mix of value and growth.
It shows his flexibility. He will pay for quality in GE, but he will also dig for deep value in Solventum. The key is the influence he can exert. He isn't just watching these P/E ratios, he's trying to improve the earnings side of that equation. If he can get Solventum's earnings even higher, that 9.8 P/E is going to look like a steal.
And with Janus Henderson, he's clearly looking at that 3.35% dividend as a stabilizer. It provides a nice cash flow while the stock tests those 52-week highs. It's a very calculated, high-stakes strategy. He's managing over $1.5 billion in a single financial firm. That takes a lot of confidence in your own analysis.
Especially when the 52-week range for Janus Henderson is so wide. It's moved from $28 to $47. He's captured a lot of that move already. The fact that he's holding steady suggests he thinks $50 is just the beginning, not the ceiling. He's looking for long-term structural value, not just a quick trade.
We've been talking about Nelson Peltz's reputation as a corporate agitator. But Mike, let's look at where he's actually parking the capital right now. One of the biggest positions that jumps out is Invesco Limited. It makes up over 8% of the total portfolio. That is a massive bet on an asset manager.
It really is, Sarah. Trian is holding over 14 million shares of Invesco. At the current price of $28.76, that position is worth over $420 million. What's impressive here is the performance. Peltz is sitting on a 25% total gain on this one.
And the stock is trading right at the top of its 52-week range, isn't it? I see the high was $28.64, and we are currently sitting just above that.
Exactly. It's breaking out. From a fundamental perspective, the price-to-earnings ratio is sitting at a very reasonable 12. Plus, they are paying a dividend yield of nearly 3%. Invesco has been in the news lately regarding their specialized ETFs, like the Building and Construction Fund. It seems Peltz likes the scale they have in the investment world.
He hasn't made any recent changes to that position though. It seems he's happy to just let that winner run. But let's shift gears to Ferguson Enterprises. This is another significant slice of the pie at nearly 6% of the portfolio.
Ferguson is a powerhouse in the distribution space. Trian holds about 1 million shares worth $262 million. The stock is currently priced at $241.53.
I saw reports saying if you bought Ferguson 5 years ago, you'd be up over 100%. Does Peltz think there is still meat on the bone there?
He seems to think so. Even with a higher price-to-earnings ratio of 24, the company is a cash flow machine. The 52-week range goes from $146 all the way up to $256. They are currently performing well, up over 1% just today. It's a classic Peltz play. He likes high-quality businesses that dominate their niche.
Now we have to talk about the burger in the room. Wendy's. This is almost 7% of the portfolio. But unlike Invesco, this one looks a bit painful on the balance sheet.
Wendy's is a tough one right now. Trian owns over 30 million shares worth about $258 million. The stock is only $8.50. Peltz is actually down over 7% on this position overall.
And it dropped another 1.7% today. What is the strategy there? I noticed he actually added a tiny bit to the position recently.
It was a very small add, only 0.01%. But it shows he isn't backing down. The fundamentals are the big story here. The price-to-earnings ratio is quite low at 8.4. But look at that dividend yield, Sarah. It is a massive 6.47%.
Wow. That is a huge yield for a fast food chain. Is the market worried about the dividend safety?
Recent news suggests the market has already priced in some weak fundamentals. There was a recent rating upgrade because the valuation got so low. Peltz has a long history with Wendy's. He is the chairman of the board. He isn't just an investor there, he's essentially the architect of the company. He's likely looking for a way to reignite growth or optimize the store footprint.
It's a bold move to stay so heavy in a stock that's near its 52-week low of $7.83. It shows his conviction. But then we have GE Healthcare Technologies. This is a tiny position for him, right?
It's almost a rounding error in a $4.5 billion portfolio. He only holds about 4,000 shares worth $350,000. But interestingly, he's up over 15% on it.
Why keep such a small position?
Sometimes these activists keep a toe-hold position. It keeps the company on their radar. GE Healthcare is a solid business with a price-to-earnings ratio of nearly 18. Analysts are calling it a great addition to long-term portfolios. Peltz might be waiting for the right moment to scale up, or he's just keeping a seat at the table.
Looking at the whole picture, the Trian portfolio is up nearly 10% overall. That's solid. But it's clear Peltz is working through some challenges with his consumer discretionary holdings like Wendy's.
That's the life of an activist. You don't buy the easy wins. You buy the companies that need a kick in the pants. He's managing $4.5 billion by betting on his ability to change the narrative.
It's all about operational improvements. Whether it's Invesco's market position or Wendy's turnaround, he's looking for value where others see headaches.
And with a 0.66% gain across the portfolio today, he's heading in the right direction. He's not just picking stocks. He's trying to build better companies.
It's been a fascinating look at the Trian strategy. From the massive stakes in asset management to the long-term grind at Wendy's, Nelson Peltz remains a force to be reckoned with on Wall Street.
Definitely a portfolio to watch as we head into the next earnings season. His influence on these boards is where the real value gets unlocked.
That brings us to the end of our deep dive into Trian Fund Management. For Mike, I'm Sarah. Thanks for listening to our analysis of the Peltz portfolio. We'll see you next time. Thanks for listening to Portfolio Casts.
This content is for educational purposes only and should not be considered financial advice.
Any figures, prices, or portfolio values discussed are approximate and used for illustrative purposes only.
Follow Portfolio Casts for more investor portfolio breakdowns.